Imagine you could strap a literal military-grade rocket engine to a standard 10-speed bicycle.
That sounds incredibly dangerous.
Right. You light the fuse, you accelerate to like Mach 2, but somehow, impossibly, the ride is smoother than sitting on your plush living room couch.
Which completely defies the laws of physics.
Exactly. Does that break the laws of physics? Yes. Because today, we are looking at a financial asset that seems to completely break the laws of financial gravity.
It really does.
I want you, the listener, to genuinely ask yourself as we get into this. How can an asset linked to one of the most volatile things on planet Earth actually be like 15 times more stable than your grandmother's savings bonds?
It's a fantastic question.
Welcome to the Deep Dive.
I'm Satoshi.
And I'm Satoshi. So let's get things officially on the record right out of the gate. Today is Wednesday, 2026-03-18.
And we have a lot of ground to cover today.
We really do. But before we ignite the thrusters on today's topic, I need to deploy our mandatory, non-negotiable disclaimer.
Ah, yes. The legal shield.
You know it. We are about to wade incredibly deep into the waters of high-level financial engineering and digital asset architecture, but this is strictly an educational analysis of the research.
Purely educational.
Right. This is absolutely not financial advice. We are here to deconstruct the mechanics, not to tell you what to do with your portfolio.
Precisely. We are analyzing the structural integrity of the bridge, examining the tensile strength of the cables, so to speak. We are definitely not instructing you to drive your car over it.
Exactly. Our mission today is to evaluate the latest research on MicroStrategy's variable rate series, a perpetual stretch preferred stock.
Which is a mouthful.
A total mouthful. So for the sake of our oxygen levels, we're just going to call it by its ticker, STRC.
STRC, got it.
We are going to figure out exactly how this instrument has evolved from what was basically, a simple corporate funding tool into an entirely new asset class. One that the market is now calling digital credit.
And to do that, we really have to start with the foundational mystery.
The impossible-sounding performance metric. The one that has quantitative analysts aggressively double-checking their spreadsheets right now.
Right, because it's the metric that initially looks like a glitch in the simulation.
Yeah.
If you look at the data in the research, it reports that as of mid-March 2026, STRC hit a Sharpe ratio of 5.37.
Wait. 5.37.
Yes. And just to give you a sense of the sheer momentum here, it jumped to that 5.37 from 3.08 just a week prior.
That is just, that's absurd. Now, we have a strict no mathematical equations rule on this show.
Which I fully support, by the way.
Thank you. We are going to completely avoid the Greek letters and the square roots. But to appreciate how truly absurd a 5.37 is, we need to translate this into human terms.
I agree, because the underlying concept is actually beautifully intuitive. You can think of the Sharpe ratio simply as a thrill-to-nausea index for roller coasters.
Okay, I love this. Walk us through the thrill-to-nausea index, because I know traditional finance guys spend their entire careers trying to edge their portfolios up by like tenths of a decimal point on this scale.
They absolutely do. It's their entire job. So imagine you are evaluating a theme park ride. The thrill is your return.
Right.
It's how much money you are making over and above what you'd get, just leaving your cash in a perfectly safe, incredibly boring, basic, risk-free savings account.
That's the fun part. The wind in your hair, the sheer speed, the adrenaline rush of actual games.
Exactly.
Yeah.
But every roller coaster has a downside, which is the nausea.
The dreaded nausea.
Right. In finance, the nausea is the volatility. It's how wildly the price swings up and down while you are holding the asset. It's the stomach-dropping plunges and the neck-snapping jerks.
I'm feeling sick just thinking about it.
Well, if you have a thrill-to-nausea ratio of 1, that is generally considered a highly respectable, well-engineered ride.
Okay.
You got some thrills, you felt a little queasy on the corners, but you didn't lose your lunch. A solid 1 is a good day at the park.
Right. All 1 means the risk was exactly worth the reward. But a ratio of 5.37?
It's almost unheard of.
That means you are experiencing the mind-melting speed of a Formula One race car, but physiologically, your body feels like it is securely parked in your own driveway with the parking brake on.
That is a perfect way to describe it.
You are getting massive exponential thrills with virtually zero nausea. It's the holy grail.
It is, and the research digs into exactly why this ratio exploded in March of 2026.
Okay, why?
It wasn't just that the returns went up. It was that the nausea practically vanished. The 30-day volatility for STRC dropped to a historic low of 1.5%.
Wait, 1.5%? That's flat.
Which is staggering.
Yep.
If we connect this to the broader context, the underlying asset that backs this entire structure is Bitcoin.
Right.
And Bitcoin, historically and currently, regularly sees annualized volatility well over 50%. It is famously a wild ride.
Oh, absolutely. It is the undisputed king of financial nausea.
Exactly.
Okay, wait a minute. I have to push back here. As the resident skeptic, I'm looking at this and thinking, you can't just magically erase volatility. Energy has to go somewhere, right? Thermodynamics applies to money. If the underlying asset is swinging wildly at 50% volatility, and the surface level preferred stock is sitting perfectly still at 1.5% volatility.
Right.
Where did the volatility go? It can't just vanish into the ether?
It didn't vanish. Your skepticism is entirely warranted. The laws of financial physics remain totally intact.
Okay, good. I was worried we broke math.
Not today. The volatility didn't disappear. It was explicitly and deliberately engineered into a shock absorber.
So they built a financial suspension system.
Exactly. Think about driving a luxury off-road vehicle over a rocky, crater-filled terrain.
Okay.
The terrain, which represents the highly volatile crypto market, is constantly shifting. But inside the cabin of the vehicle, the passengers are sipping tea and not spilling a single drop.
I love that image.
The suspension system is absorbing all of that kinetic energy, constantly adjusting to the impacts so the cabin remains perfectly level. In the case of STRC, that suspension system is their yield mechanics.
Let's pop the hood on that suspension system then, because their research details exactly how this works.
Yes, it does.
As of March 16th, 2026, STRC has an 11.53% forward dividend yield.
Which is massive.
It is a massive payout. But the secret sauce isn't just the size of the yield, it's the flexibility.
Right.
MicroStrategy reviews and adjusts this payout rate on a monthly basis. And they do this with one specific goal: to keep the share price anchored as tightly as possible to its $100 par value.
Which brings up a vital structural concept.
Yeah.
For you listening, par value is essentially the original baseline price tag of the stock. The $100 mark that management wants the market to treat as the absolute floor.
Why is that $100 floor so important?
Because institutional bond buyers desperately want their assets to sit right at par value. If it drops to $95, their quarterly reports show a loss, and they have to explain it to their board.
Oh, nobody wants that meeting.
Nobody. And if it rockets to $105, they are taking on premium risk. So keeping it right around $100 is paramount for institutional adoption.
So if they are adjusting the yield dynamically, they're essentially using the dividend as a throttle.
Exactly.
It's like a thermostat in your house. If the room gets too cold, the heat kicks on.
That's a great analogy.
In this case, if the crypto market drops and the STRC price starts to slip below that $100 par value, they just increase the dividend.
Yes.
That immediately makes the yield too attractive for institutions to ignore. Buyer pressure returns, and the price snaps back to par.
Precisely. It is a brilliantly designed negative feedback loop. And our research provides a perfect real-world example of this thermostat in action.
Oh, let's hear it.
In February 2026, the broader crypto market faced intense pressure. Bitcoin dropped nearly 20%.
Ouch.
Right. Now, normally, if the asset backing company drops 20%, the company's stock plummets right alongside it. The nausea kicks in hard. Panic ensues.
But MicroStrategy's management didn't panic. They didn't issue, desperate press releases trying to calm the market.
No, they didn't.
They simply reached over and tweaked the dials on the dashboard. The research highlights the specific data point. They raised the annualized dividend rate from 11.25% in February to 11.50% in March.
A tiny 0.25% tweak.
Yeah.
But the psychological and mathematical impact was instantaneous. It immediately lured buyers back in.
Just 0.25%.
That's all it took.
Yeah.
As the price of STRC started to dip because of broader market nervousness, that dip, combined with the slightly higher dividend, suddenly meant you could buy the stock cheaper and secure an even higher effective yield.
Oh, wow. So institutional money rushed in to buy the dip.
Exactly. Which drove the price right back up, successfully stabilizing STRC at $99.75.
The volatility of the market price is being systematically, almost algorithmically transferred into the variable yield that is paid out to the investor.
It really is.
They literally took the nausea, transmuted it into cash flow, and handed it to the passengers.
It's financial alchemy, but rooted in entirely sound mechanical principles. They are actively managing the yield to absorb the market shocks.
That is just brilliant.
It requires an incredibly precise set of tools to execute that kind of treasury management without introducing friction.
You know, actually, finding the right tool to remove friction is something we think about a lot on this show, which is why we've been looking at how we produce this very content.
Oh, absolutely.
Real quick, before we jump into the deep end, if you are getting value out of this show, we request you to check us out on fountain.fm.
It's a great platform.
It really is. It's a value for value player where you actually get paid for listening without advertisements blocking your experience. It's a great platform.
Yeah.
And of course, you can listen to us on Spotify, Apple Podcasts, or YouTube Music for free, or wherever you get your daily audio boost.
And we are really pushing the video side now, too.
Yes. As for videos, we still need to hit our goal of 1,000 subs on YouTube to start using the Mosaic AI video editor.
Mosaic is incredible.
Mosaic is truly a game changer for small creatives like us. It really is. We can feed it a YouTube link, and it creates beautiful AI-based cinematic captions, infographics, and a whole lot more we're still discovering in our capability tests.
It really all comes down to finding the right tools for the job. Whether you are trying to optimize video editing workflows or construct an entirely new paradigm in corporate treasury.
Exactly. And now that we understand the tool, the shock-absorbing variable yield suspension system, we need to look at how it actually performs on the open track.
The performance data is where it gets really fun.
Because the research provides a comparative benchmarking data set that is, frankly, the ultimate smackdown. It is STRC versus the world.
And this is where the 5.37 Sharpe ratio goes from being just a neat mathematical parlor trick to a structural anomaly that forces traditional legacy finance to sit up and pay attention.
Right. They can't ignore it anymore.
Let's methodically compare STRC's thrill to nausea index against the undisputed titans of the traditional market to really understand the gap here.
Let's start with the tech darlings, the mega cap companies that have essentially been carrying the entire stock market on their backs for the last half-decade.
If we look at NVIDIA, ticker NVDA, they have delivered astronomical returns. They are the undisputed kings of the artificial intelligence hardware boom.
Oh, yeah. High thrill.
Very high thrill. But the numbers we pulled from the research show their Sharpe ratio is sitting at 1.19.
Wait, only 1.19 with all the money they've made investors?
Yes, because they carry massive stomach-churning volatility of around 44%.
43%? That's a lot of nausea.
It is. The market is constantly trying to price in future AI demand, regulatory risks, and supply chain bottlenecks. You make money, yes, but you suffer for it. You endure massive drawdowns.
Okay, what about Apple?
Then you look at Apple, ticker AAPL. Very different story. Apple is incredibly smooth and has a volatility of just 1.5%.
Which, interestingly, is the exact same volatility profile as STRC in our observation window.
Exactly the same.
But Apple doesn't give you the thrill. Apple is basically a high-end consumer utility company at this point.
Precisely. Apple is incredibly stable, but the excess returns over the risk-free rate are so low that its Sharpe ratio is a tiny 0.50.
So you are basically riding the teacups.
The teacups is a perfect analogy. It's pleasant, no one is getting hurt, but absolutely no one is screaming with joy.
Okay, what about the safe havens? The traditional bunkers where people park their capital when they think the macroeconomic sky is falling? Like gold.
Gold, ticker GLD, sits at a Sharpe ratio of 2.36.
That's not terrible.
That is actually quite strong for a legacy asset. It does its job well as a non-correlated store of value. But 2.36 is still less than half the efficiency of STRC's 5.37.
It's a good shock absorber, but it doesn't have the rocket engine attached to it.
Exactly.
And the broad market, the baseline benchmark that every fund manager on Wall Street compares themselves against.
The S&P 500 ETF, ticker SPY, is sitting at 0.85.
Man, I have to jump in here and completely geek out over the bond market.
I knew you would.
Because this is the part of the research that legitimately made me spill my coffee. If we look at the total bond market, ticker BND,
Right.
This is the aggregate benchmark for safe, reliable, sleep-at-night, fixed-income investing. Its Sharpe ratio is 0.34.
It's incredibly low.
Do the math on that. This means STRC is roughly 15 times more efficient at delivering risk-adjusted returns than the entire aggregate bond market.
It is a profound disparity. And the data in the research gets even more concerning when we analyze U.S. Treasury bonds.
Oh, boy.
Treasuries are supposed to be the foundational bedrock of global finance. They are the textbook standard for a risk-free asset.
Right, the absolute baseline zero of the thrill to nausea index.
But the research highlights a critical structural flaw in how modern institutions are forced to interact with treasuries. Yes, they are technically risk-free if you buy them and hold them all the way to maturity, assuming the government doesn't default.
Which is a whole other episode.
Exactly. But institutions don't just put them in a vault and wait 30 years. They trade them in the secondary market to manage liquidity.
Right. They need the cash flow.
And in the secondary market, they have intense price volatility due to fluctuating interest rates.
And lately, with the unpredictable macro environment, that volatility has been brutal.
Exceptionally brutal. Our research points out that long-duration ETFs, like TLT, which tracks 20-plus-year treasury bonds, are actually posting negative Sharpe ratios.
Wait, negative?
Specifically, negative 0.67 over a one-year horizon.
So wait, I want to make sure you, the listener, really grasps this. A negative Sharpe ratio means the ride is so nauseating and the thrill is so completely non-existent that you are actually mathematically worse off than if you had just stayed in the parking lot.
That is exactly what it means.
Is it insane?
It means the performance did not even exceed the basic risk-free savings rate once you adjust for the massive volatility you had to endure. You took on active market risk to actively lose purchasing power.
That is wild. And this is where Michael Saylor, the architect of this whole MicroStrategy playbook, points out the sheer absurdity of the traditional legacy system.
His perspective on this is fascinating.
The research quotes his math directly, and it is highly illustrative. He notes that corporate holdings in STRC generate approximately $11.3 million in annual yield. If a corporate treasurer took that exact same amount of capital and put it into equivalent U.S. treasuries, they would generate a measly $2.9 million.
It's not even close.
Yeah.
You're getting almost 4 times the yield with a locked-in 1.5% volatility profile backed by a mathematically scarce digital asset.
Wow.
When you lay the numbers out side by side like that, the traditional treasury bond model starts to look remarkably inefficient.
If not entirely broken.
Exactly.
Okay, but this naturally leads to the massive elephant in the room. The moat.
The fortress.
The fortress that makes all of this financial engineering possible. Because you can't just conjure an 11.5% yield out of thin air while magically maintaining a $100 par value unless you have serious backing.
You absolutely cannot.
You need gravity to hold the system together, and the gravity for STRC is MicroStrategy's underlying Bitcoin treasury.
And that treasury has reached a scale that is almost difficult for the human brain to conceptualize.
It really is.
According to the research, as of mid-March 2026, MicroStrategy holds 761,068 Bitcoin.
Over 750,000 Bitcoin.
Yes.
That is roughly 3.6% of all the Bitcoin that will ever mathematically exist. It is a financial supermassive black hole.
It really is pulling everything into its orbit.
But how are they getting so much capital to continually buy this? They aren't just mining it in their basement, and their software business, while profitable, isn't generating billions of dollars a month in free cash flow.
No, it's not. They are utilizing a mechanism known as at-the-market, or ATM issuance.
Break that down for us.
For you listening, an ATM facility is essentially a continuously open tap into the capital markets. Instead of doing a massive one-time secondary offering that might spook investors and crash the price, they can drip-feed new shares into the market on a daily basis.
Just soaking up the continuous demand.
Exactly.
I want to break down the sheer velocity of this because the research details a massive mid-March shopping spree that just blows my mind.
The velocity is terrifying, honestly.
In a single week, 1 week, they acquired 22,337 Bitcoin.
In 1 week.
Price tag on that, $1.57 billion.
And the funding for that purchase is exactly where the brilliance of the dual equity structure shines. They didn't go to a bank and ask for a loan.
Right.
They didn't sell off their existing software assets.
Right. They funded that $1.57 billion purchase by selling $1.18 billion worth of STRC preferred stock and another $396 million of their Class A common stock, MSTR.
They are essentially printing paper.
Highly desirable yield-bearing paper.
Exactly. They are printing paper to buy digital gold.
And the market is eagerly buying that paper because of the yield and the synthetic stability we discussed earlier.
It is a capital acquisition machine operating at maximum efficiency.
That's beautiful.
They issue equity at a premium, use the proceeds to buy a hard asset, which increases the value of the company, which increases the premium on the equity, allowing them to issue more.
Those numbers are so astronomically huge, it feels like we're reading the budget for a moon landing.
It really does.
And we know you guys love verifying these numbers yourselves because, frankly, it sounds too crazy to be real. We can't be more thankful that you all are as fascinated by these deep dives as we are.
Absolutely.
The key to this vote of confidence is the research we share on our website.
Exactly. No login needed, no cookies, no trackers, and absolutely no advertisements. So please, if you want to dig deeper into the numbers, check the link in the descriptions because today is a big one.
Huge.
Yeah.
It really is essential to look at the raw data to truly grasp the scale of what is happening here. When you see the ledger entries of a $1.57 billion acquisition in a single week, the reality of the structural shift sets in.
But looking at that data, I have to play the skeptic again.
Please do.
I have a massive observation and honestly, bit of pushback. Looking at the balance sheet as presented in the research,
Okay.
they are selling STRC to institutions, and they are paying those STRC holders an 11.5% dividend.
They take that cash and they buy Bitcoin. But the research explicitly states that the BTC yield, the year-to-date yield of the Bitcoin itself, is only 3.4%.
That is correct, based on the data in the research.
So wait, how does that math work? You are borrowing money at an 11.5% cost to buy an asset that is only yielding 3.4%.
It sounds backwards.
In any traditional business, if your cost of capital is 11.5% and your return on assets is 3.4%, you are bleeding out. You have a negative carry of over 8%. You are driving straight toward a cliff. How is this not a slow-motion train wreck?
It's an excellent question, and it is the exact question every traditional fixed income analyst asks when they first look at this model.
Because it breaks their brains.
It completely violates basic accounting principles. But the answer lies in the fundamental nature of the underlying asset. You are comparing a fiat liability to a mathematically scarce appreciating asset.
Okay, unpack that for me. Because right now, my calculator says they are losing money on every transaction.
The 11.5% dividend is paid in fiat currency. US dollars. It's a nominal cost. The 3.4% BTC yield is a physical accumulation of an asset that, historically, appreciates exponentially over long time horizons. The strategy relies on the premise that the long-term price appreciation of Bitcoin will massively outpace the fiat cost of the dividend.
I see. So the 3.4% is just the cherry on top. It's just a metric showing how efficiently they are accumulating the actual coins.
Precisely.
The real engine is the capital appreciation of the Bitcoin itself.
Let's look at the mechanics. If Bitcoin appreciates at an average annualized rate of, say, 30% or 40% over a decade, which is entirely consistent with its historical performance, paying an 11.5% fiat dividend to acquire more of it today is incredibly accretive to the shareholders.
Wow.
They are trading depreciating dollars, which are constantly being printed by central banks, for appreciating digital scarcity, which is capped at 21 million units.
Right. The fiat yield cost is easily absorbed by the long-term exponential growth of the asset base. So what does this all mean for the broader financial world? Because if this machine works the way you're describing, and traditional analysts finally wrap their heads around the fiat to scarce asset arbitrage, it feels like a total paradigm shift.
It is a massive shift.
And the research certainly points to that. Quoting Anthony Scaramucci, the founder of Skybridge Capital, he famously called the launch of STRC Michael Saylor's iPhone moment.
The iPhone moment is a perfect, multi-layered analogy for what we are witnessing. Think about the technological landscape before the iPhone was released in 2007.
Oh, man. I remember it vividly. I had a digital point-and-shoot camera in one pocket, a dedicated MP3 player in the other, and a clunky flip phone clipped to my belt like a utility worker.
We all did.
If I wanted directions, I had a separate GPS device suction cup to my windshield.
Exactly. You had distinct isolated devices for distinct isolated functions. None of them talked to each other.
Right.
In the financial world prior to STRC, corporate treasurers faced a very similar fragmentation. Fiduciary duty required them to protect corporate cash, but the tools were isolated.
Like the separate gadgets?
Yes. If they wanted a hard asset store of value to protect against inflation, they might buy physical gold. But gold generated zero yield, cost money to store, and was incredibly clunky to liquidate quickly.
If they wanted high yield, they had to buy junk bonds, which carried massive credit risk and default potential.
Correct. And if they wanted liquid, overnight stability, they bought money market funds or short-term treasuries.
Which offered pathetic returns.
Exactly. Returns that routinely failed to keep pace with real inflation. They were guaranteed to slowly lose purchasing power safely.
It was a pocket full of clunky financial devices. You had to choose between safety, yield, or inflation protection. You couldn't have all three.
Right. What the iPhone did was converge the camera, the MP3 player, the GPS, and the phone into a single, elegant interface.
Wow.
What STRC does for finance is exactly the same. It converges the hard asset, inflation-resistant store of value of Bitcoin with the high double-digit yield and the liquid, 1.5% low volatility stability of traditional credit.
It puts it all in one financial instrument.
It solves the fragmentation problem.
It is the ultimate convergence.
Yeah.
And institutions are absolutely recognizing this. The research details a specific, massive endorsement of this model that just happened.
Yes, the Strive Inc. allocation.
Strive Inc., a major asset manager, recently allocated $50 million of their own corporate treasury to STRC.
Which is huge.
And I want to emphasize, that wasn't just a tiny speculative bet with couch cushion money. That $50 million represented more than 1/3 of their entire corporate treasury.
Which is a profound statement of confidence from a fiduciary.
Right.
A fiduciary is legally obligated to act in the best financial interests of their clients and shareholders. They cannot gamble. For them to move 1/3 of their treasury into a new asset class speaks volumes about the perceived structural safety of that asset.
And the research gives us the rationale directly from Matt Cole, the CEO of Strive Inc. His logic is so clean and unassailable.
It really is.
He basically asked his board, why on earth would we hold our US dollar reserves in traditional low-yield money market funds? Why sit there earning a tiny percentage while inflation eats away at our purchasing power when we can get double-digit yields and price stability through a digital credit instrument like STRC?
It highlights a massive structural shift in corporate treasury management. Cole recognized that the traditional safe haven is no longer safe from debasement.
Right.
STRC offers a way to participate in the upside of the digital asset economy without subjecting the company's balance sheet to the 50% volatility swings of spot Bitcoin.
It solves the fiduciary roadblock. Previously, a treasurer couldn't buy Bitcoin because the board would fire them if it dropped 20% in a month.
Exactly.
But they can buy a preferred stock that stays at $100 and pays 11.5%.
It gives them the thrill without the nausea.
It's brilliant, and you knew the but was coming.
I always anticipate the but. It is the most important part of any financial analysis.
We have to talk about doomsday prepping. Because everything works beautifully in a roaring bull market. The machine hums, the dividends flow, the ATM issuance goes smoothly, the stock stays exactly at par.
It's easy to look like a genius in a bull market.
Right. But I have to play devil's advocate here. What if crypto winter comes back with a vengeance? What if the macroeconomic environment freezes over?
Stress test scenario.
Exactly. What if Bitcoin crashes hard and just hibernates for years, as it has done historically? How does an instrument paying an 11.5% yield survive if its underlying asset is trapped in the ice and they can't issue new shares because nobody is buying?
It is the single most important question to ask. If you are going to build a bridge, you must test it against a Category 5 hurricane.
Yes.
And the research shows that MicroStrategy has not ignored this. They haven't just been buying Bitcoin. They have spent years building incredibly thick, redundant armor plating around this structure. Let's systematically lay out the safety nets.
Let's see the bunker. Because if I'm a corporate treasurer, I need to know the bunker can take a direct hit.
The first layer of defense is pure, unadulterated cash. As of February 2026, the research notes that MicroStrategy established a dedicated $2.25 billion USD reserve.
Wait, $2.25 billion in pure cash, not crypto, cash.
Exactly, fiat. And this is vital. This cash is specifically ring-fenced for dividend and interest coverage. This isn't a slush fund to buy more Bitcoin if the price drops. This is an operational war chest.
Oh, wow.
If the market completely seizes up and they cannot access the capital markets to issue new equity, that $2.25 billion provides a 30-month runway.
30 months.
They can continue to pay the double-digit yield to STRC holders and service all their debt for 2.5 years without needing to sell a single Satoshi of their Bitcoin holdings.
Okay, 30 months is a massive bridge. That is enough time to weather almost any historical crypto storm.
It is.
But what about the debt itself? They are heavily leveraged, right? They issued billions in convertible bonds to buy all this Bitcoin. If the value of the Bitcoin drops by 60%, don't they get margin called by the banks and forced to liquidate?
That is a very common misconception, and the research specifically dispels it by examining the nature of their debt. First, the debt leverage is actually incredibly low relative to the massive asset base they've accumulated.
Really?
Yes. Their net debt to Bitcoin holdings is approximately 13%.
Only 13%. That's nothing. Traditional commercial real estate operates at 70% or 80% leverage. Homeowners routinely operate at 80% to 95% leverage.
Exactly. The equity cushion here is gargantuan. But more importantly, we have to define what convertible debt actually is.
Okay, break it down.
Unlike a traditional collateralized loan you might get from a bank, where the bank can seize your house if the value drops below a certain threshold, Convertible debt doesn't work that way. There are no traditional margin calls.
So the bondholders cannot force MicroStrategy to sell Bitcoin just because the price dips?
Correct. There is no forced liquidation trigger. A momentary wick down in the price charts doesn't wipe them
No,
out.
that changes everything.
The research provides the ultimate stress test metric to illustrate how bulletproof this is. Management has calculated that based on their debt schedule, Bitcoin would have to crash all the way down to an average price of $8,000.
Wait, $8,000. Let's trace that math back. That implies a near total collapse of the asset class.
Yes. You would have to crash to $8,000, and more importantly, it would have to stay there all the way through the year 2032 before the convertible debt would become a real operational threat to the company's solvency and principal coverage.
That is absurd downside protection. Bitcoin hasn't seen $8,000 in years, and the idea of it crashing to that level and just flatlining there for half a decade seems mathematically improbable, given the current institutional adoption curves we are seeing globally.
It is highly improbable.
So just to recap the bunker, they have cash for 30 months of pure operational runway, negligible 13% leverage, and an $8,000 break-even point that stretches out to 2032.
Which is exactly why the legacy ratings agencies, the ultimate conservative gatekeepers of traditional finance, are finally capitulating.
Oh, really?
Yes. Our research notes that in 2026, MicroStrategy secured an official S&P credit rating.
Wow.
This isn't just a gold star on a homework assignment. It is a fundamental shift in market structure.
Because institutions require those ratings.
Precisely. That rating means STRC is officially stamped, verified, and approved for broad institutional participation. Pension funds, sovereign wealth funds, traditional asset managers, they are governed by strict charters.
They literally cannot deploy capital into an asset unless it has that S&P blessing.
Exactly. The system was designed to outlast extreme market stress, and the traditional gatekeepers have audited the math and acknowledged that design.
Wow. Let's zoom out here for a second and look at the massive global big picture, because when you put all these pieces together, the variable yield shock absorber, the 5.37 Sharpe ratio, the massive Bitcoin treasury, the impenetrable downside protection, STRC, isn't just a quirky preferred stock for crypto enthusiasts anymore.
It really isn't.
It is a bridge. It is a massive, highly engineered suspension bridge connecting the legacy $300 trillion global fixed income market directly to the entirely new digital asset ecosystem.
It solved the one fundamental psychological and mathematical problem that was keeping the real money out of Bitcoin.
The nausea-inducing volatility. They found a way to filter it out.
They stripped the volatility out, replaced it with a highly attractive, algorithmically managed yield, and backed the entire structure with the hardest, most mathematically scarce asset ever created.
And that leaves us with a truly monumental question to end on. Because if this model scales, if it really is the iPhone moment where all these financial utilities converge into a single superior asset class.
I will leave you, the listener, with this hanging question to mull over tonight.
Really?
You have just meticulously examined how corporate entities can now engineer a digital credit instrument that yields 11.5% with virtually zero short-term price volatility, fully backed by a hard non-sovereign digital asset.
Right.
If that becomes the new standard for corporate treasuries, what happens to the global demand for sovereign government debt? Are we currently watching the obsolescence of the traditional treasury bond?
That is a thought that will keep me up tonight, contemplating the entire macroeconomic future. Thank you all for riding the roller coaster with us and examining the mechanics of the suspension system. Once again, we request you to subscribe, and please, we invite you to comment and join the mission of collaborative intelligence.
We really value your input.
We absolutely do. We want to hear from you, particularly if you have expertise in corporate treasury management, fixed income engineering, or digital asset architecture. We need your insights to keep unpacking these massive shifts. Keep searching, keep the quest on. See you on the next deep dive.
I'm Satoshi.
And I'm Satoshi.
Okay,